Hi, this is Jason, Chief Technical Analyst with Toro Alerts with your weekly market update. I was on vacation this last week and I picked a good time to take the week off as we closed the week where we basically opened the week on the S&P 500. A lot of volatility in between that space, and so that makes it pretty tough to trade around. And so it was really a pretty good week, I think, just to take a break from trading and get out and enjoy some sun. But the good news is we've got some opportunities based on the price action we've seen over the last week to potentially set up some trades going forward into this coming week. So we'll dive into that more, and we'll start out with the S&P 500 chart, taking a look at what we're seeing there. We did close, as we said, right where we opened on the week. The 413.50 level is definitely a key resistance level now that we'll be watching for. If we get back above there, we might see a short-term rally. But if we stay below the 413.52, I'd expect further downside. And the next two targets to the downside we're looking at it on the SPY would be 390, and then after that 359. I think there's a pretty decent chance that we get back to the pre-pandemic levels on the SPY, which would actually put us all the way down to about the 339 level for potentially an actual bottom on this correction that we've been going through for a while now. But we still got quite a ways to go to that, so we like to look at some of the more shorter term levels to watch for potential bounces to trade off of, or just if you've got shorts in the market to kind of be aware of these key levels. So 390 and 359 are the next two on the SPY that we're watching closely for potential downside short-term targets. And then we jump over to the NASDAQ, the triple Q chart. The next target to the downside, we did bounce off this 303.75 level. But once we get below that, then I would be looking for the 282 level, which is a Fibonacci extension level in the shorter term to the downside. And for a possible bottom in this correction, we could be looking at as much as 237.70 for the bottom, which is a pre-pandemic level on the triple Qs. And then when we take a look at the Dow Jones Industrial Averages, the next target to the downside on that is we move well below some volume resistance and support levels that we've been watching that we've bounced around up here. And then we did sell off over the last couple weeks, and now we're pretty clearly down below those levels. The next Fibonacci extension level to the downside would be the 311.60 level we're watching, and then a possible complete correction into the Dow Jones Industrial Averages could be sitting at around the 296 level, so we'll be watching those levels closely there. And then on the Dow Jones Transportation, we've talked about how that's been holding up through this channel so far, and it's maintained that this week, although it's had a tough time getting back up to much of any new highs. Really over the last 3 weeks, it's kind of chopped sideways. It's tried to get up above the 50-week moving average a few times, but failed each time. And really probably looking for that to break down and fail below the 1435 level. If we see the Dow Jones Transports sell off below that level, that would just be more bearish signals in the market to be cautious. And I think we're already seeing that it's a good time to be cautious anyway in the markets. So when we jump over to the sectors, we talked about how over the last week, when we did our show last week, there really was nothing exciting to technically trade off of. There was no clear sector strength. Everything was pretty much in the red, and it was looking pretty bad out there. But this week, things are still looking pretty bad for the broader markets, but there are some sectors that are starting to emerge after last week's price action. And those major ones are really in the energy space. So we did see energy really roll over for a while now, and wasn't having a lot of upside opportunity in the recent past. But we've seen XLE have a nice move to the upside. It was in the red last week, and now it's 8.5%, almost 9% over the last 2 week period. And so it's actually probably even performed better than that in the last week because it was in the red last week on the 2 week analysis that we do. And then also the United States Natural Gas Fund, obviously being in the energy sector as well, natural gas is still continuing to see some really nice moves to the upside. So it's looking like going into this week there could be some opportunities in the energy space to put some trades on. Also seeing some movement just barely in the green, but in this market that's notable. And we're seeing the solar industry starting to get a little bit of positive momentum as well. So keep an eye on that to see if that continues or not. But definitely looking like going into this next week, there should be some opportunities in the energy space to look for. So we'll be keeping an eye out for that. Then we jump over to the Russell 3000 chart. We've been watching the center channel for quite some time, talking about how we'd expect at least a drawdown to the center channel. Based on everything that's happened, both geopolitically and with the money tightening policies, I think there's a good chance we actually sell off to this bottom channel here. And so I would really expect almost for sure to get down to this middle channel, which we're just about there. Really, I think there's a good chance that we get down to this bottom channel here in this Russell 3000. And this channel is really interesting because it goes back quite some time. The bottom of this channel was formed at the bottom of the financial crisis, and the top of this channel was kind of as we were starting to recover, and it's really maintained this channel for 12 plus years now, 14 years now, and so it's a pretty nice reliable channel to trade off of. A lot of kind of angle channels can be a bit interpretive and not always super accurate, but when you've got something that's got this kind of price memory and it's something that's a decade plus of validity to it, then I think there's some really good information to watch off of these charts. When we jump over to the Russell 1000, the large caps, looks like large caps tried to get above a key Fibonacci level this week, but failed pretty miserably and fell back down and is now closed out lower than it did the previous week. So large caps are still looking like they're under pressure. And we jump over to the Russell 2000 for small caps, also under pressure quite a bit. Also had a brief rally in the week, but fell back pretty hard and closed lower on the week as well. So really not seeing any obvious spaces to trade off of as far as cap size in the market. Both large and small caps are struggling. And then when we take a look at the VEU, the All World Index, minus the US, also looking pretty bad. We closed right around the 200-week moving average last week, but then this week we sold off quite a bit lower. And so there's not looking like there's a lot of great opportunities in the markets around the world either at this moment. And then we look at it on relative terms, look at emerging markets compared to the SPY. And we did talk about how there was a pretty big surge last week, but a lot of times these 1 week surges can kind of be a bit of a fake out, as we've had quite a few back and forth for really about the last month and a half or so. We see a week where we move to the upside when relative to the US markets, and then it rolls back over. And so this week we did the same thing, big move to the upside the previous week, and then just about all of it on a relative basis kind of erased just the very next week. So still not looking like a lot of great opportunities outside of the US in the markets at the moment. And then when we look at growth versus value, values continue to outperform. When we looked at our charts, the Dow Jones Industrial Averages has sold off less than, say, like the NASDAQ, and also the Dow Jones Industrial Average looks like it has less selling pressure in the future potentially compared to the NASDAQ as well. So it's definitely looking like value is a much better sector to be in, a much better space to do your trades as opposed to growth right now. And then we take a look at the U.S. oil chart. We've been watching this one for quite some time now, and we've been talking about how it's been bouncing around this bull flag or bull pennant, and it has definitely broke above that this previous week. We got a clear definitive close above that level, and so it'll be interesting to watch this over the next few days to see if it maintains that break, or if it ends up being a failed breakout and sells back off. But as long as we maintain above this trend line here, which looks like it would probably be right around 107.50 or so, if we stay above that level, then it's starting to look like there could be some bullish opportunities in the energy space, and so I'd be looking at energy stocks for some trade opportunities going into the week. And then we also saw an interesting development out of the commodities over the last week. We've been talking about for a while now about being careful about this 313.85 level. We didn't want to get in any new commodity trades as we were coming up against this key resistance level. We wanted to see it break above that and then hold it as support before we really get into some trades. Well, it just barely got above it this week, so I don't know if you want to be a little extra cautious, maybe give it another week to see if it can maintain and hold those levels. But if we see a real definitive breakout above that 313.75, we'll call it, then I think that there could be could be a good entry space to get into some more commodity trades if we see a definitive break above that level. And then when we take a look at the high yield corporate bonds, something we've been watching for some time now, good indicator for overall market health, and we've seen it just absolutely get slaughtered really since September of last year, and it really started falling off probably about the end of last year, and so it's been a pretty strong indicator telling us to be cautious in the markets anytime we break below those weekly moving averages, which we did quite some time ago. Just a couple weeks ago, we talked about the 7950 level being a key area of potential support. It did kind of hold that briefly, but then it fell through it. So now the next level on the HYG we're looking at is 7511 to the downside, and we'll see if we can get a bounce off of that, or if we see even further selling pressure below that. And when we had the COVID crash, HYG got all the way down to about 6750. So we'll see if it can get that low or not. But I think heading to 75 would probably be at least the minimum downside on that, if not further. And then we like to look at HYG divided by IEI. So we're looking at corporate bonds versus traditional bonds. And when you look at that on a relative basis, and that gives us some good information of how things are going in the market, comparing corporate bonds compared to treasury yields. And we broke below a key 0.66 level we've been watching 2 weeks ago, and then it looks like it tried to get back up above that level this last week, but failed pretty bad, and ended up closing down even further. So that's further confirmation that there's a lot of warning signals in the market at this point. And then we look at our consumer discretionary versus consumer staples, and that's been in a clear downtrend for quite some time, since about November of last year. So people will be getting defensive, getting into sectors like consumer staples, utilities, and things of that nature. And so anytime you see this chart really go to the downside, then it just tells you that people in the market are getting a lot more protective with their assets, and being a lot more conservative, and taking a lot less risks in the market. So another warning sign there as we broke down below that 0.74 level. The next level we'll be watching for a potential bounce would be the 0.65 on this chart. And then let's take a look at the precious metals. If you really want to go bottom fishing for some cheap gold and silver prices, this could be a decent opportunity. Only reason I don't love bottom fishing on things like gold and silver is a lot of times you can get in at a quote-unquote bottom, but it ends up trading in a tight range for quite some time. And so if you're really bullish on the sector and you think it's about to break, you could get in at these levels. I think as long as we're above 174.50, it could be a nice trade opportunity, even in a short-term trade with the upside opportunity up to about 186. But once we really get above that 186 level, that'll be when I'll start getting really bullish on gold in the future. But if you do want to try to buy that bottom and get a good price on gold, this might not be a bad opportunity to take a shot on that. And then similar story with silver. We really like this call it 2050 or so level on silver. It really has not closed on a weekly basis. It hasn't closed below, say, 2040 or so per ounce, really since quite some time. And we're looking at July of 2020 was the last time we were below 20 bucks an ounce. And so this looks like a good buying opportunity. Again, if you want to go bottom fishing for some silver, you get a really good price, but just be aware that this thing can chop around for quite some time. We've been trading really in a pretty tight trading range since about July of last year, and so we're going on about 10 months of basically trading sideways between $20 and about $24 an ounce. But at some point, I still do believe that silver is going to have a nice breakout, and once it does, it's going to be a good trade to be in. But until we get above that 24.25 level, hard to say that the breakout is here. But again, if you want to just get a good price right now, probably a decent entry point on silver if you've got a long enough time horizon. And then take a look at the DXY chart. We talked about the 103.85 level as a key resistance level to watch out for, and it's respected that level pretty impressively, really for about 2 weeks now. And now we're going into this third week here where it's kind of up against these levels. So we'll see if it pushes up further to the upside. My guess is probably it does. And if we do move above the 103.85, then the next key level on the DXY we'll be looking at is about 107.70. And then let's jump over to the interest rates and take a look at what's going on there. We're starting to get some pretty extreme levels. Rate of change on these interest rates have been pretty historic, and so still kind of looking for that potential rollover in the rates, even though people are still talking inflation and rising rates and a bunch more Fed rate hikes coming in the near future. I think there's still a pretty good chance that we are going to have some rollover here, shorter than most people think, I think. And so some of the key levels that I'm going to be watching for is if it rolls over at the 2.983, so basically call it 3% on the 2-year, and I think that could be a potential bond trade entry position there if we see a real definitive rollover from that point. But be careful with these because we are going through some historic times on these, the rate of change on these rates. And so just because historically it's telling us that these things should roll over pretty soon, historically these things should have rolled over already, I think. So you want to see a pretty definitive rollover, I think, from those levels. But if we do see that at the 2.98 or 3% on the 2-year, that could be a signal that the rates are cooling off at some point. But we'll want to watch for the price action on that to see what it tells us. And when we take a look at the 10-year, key level I'll be looking at on that is about the 3.3, call it, percent range on the 10-year, and see if there's a potential for maybe a rollover there on the 10-year interest rates. And then over on the 30-year, bond yields were above a key level at about 3.23. Our level here that we had set was 3.225, so we just broke above that level. If we maintain that going into next week, I think the next level above that would be about 3.47, call it 3.5, and then we might be looking for possibly a rollover from there, or it could just keep going higher. We'll keep an eye on the price action and see what it does. And then we take a look at the yield curve. Interesting week on the yield curve. It actually had a pretty strong move to the upside, but it did hit this 0.38 or 0.39 level that has been acting as resistance, and so we'll watch this going into this upcoming week to see if that once again acts as a resistance point and if we see a rollover on the yield curve or if it actually continues to move to the upside. Then we jump over to the VIX. VIX has been extremely elevated. Anything above 30 is pretty elevated VIX levels, meaning there's a lot of volatility in the markets, and it's always a good time to be really careful when we're above the 30 level. You can make some good money when it's above 30 because it doesn't always mean to the downside. It just means we got fast moves happening. And so it's important to have tight stops and know your sectors and know what trades you're in, because those trades can either make you a lot of money or blow your account up really fast when the VIX is above those levels. And we were above 35 too for at one point. So then we just did sell off on Friday and got down to about the 30 level. So it'll be interesting to see what happens this week if we stay elevated above the 30 level or if we roll over and see the VIX drop a little bit. And then we look at the put-call ratio. Anything above 1 is elevated protection in the markets. Anything above 1.25 is pretty extreme elevated protection in the markets. We are heading back towards that range, and so there is a lot of people buying protections and shorting the market right now. And then we'll go ahead and wrap it up with some cryptocurrencies. We're going to, I think, start adding these into our weekly recap since a lot of people are trading crypto, and we've got our crypto trading app out, and we'll go ahead and dive into Bitcoin and see what it's doing. Bitcoin's at a pretty interesting level right now, right around the 34,000 level. This could definitely be a short-term triple bottom in the markets, and so we could see a short-term bounce off of this level. But if we do, I would expect to probably just get up above this trendline channel, which maybe gets you up to 36 to 38,000 on Bitcoin. If we do see a short-term bounce off of that, I wouldn't expect it to go much higher than 38, 39,000, and then we'd probably see a rollover for some further selling pressure. I'm thinking that 30,000 is going to be a really key level to watch on Bitcoin. It's respected that level for quite some time. The last time we saw Bitcoin roll over after we had that nice run to the upside, it really held and respected that 30,000 level quite a bit. And I think there's quite a few bigger money players, they call them whales in the crypto space, that I think are kind of hanging out waiting for that opportunity. And so I think if we do get to the $28,000, $29,000, $30,000 level in Bitcoin, I think there will be quite a bit of buyers there. And so even if that's not the bottom, I think there could be a good opportunity for a short-term bounce, if nothing else, if we get down to that 30,000 level, which I think there's a good chance we will. And then there are some people calling for, Bitcoin all the way back down to say 20,000. I'm not going to say it's impossible, but I'm certainly not rooting on that. I'm hoping to see Bitcoin hold that 30,000 level. I think that would really show a really good sign of strength in Bitcoin if we did. But if we did break down below, let's say the 28 to 30,000 level, then we could see a further selling pressure all the way down to about 20,000 in Bitcoin. And then we'll go ahead and wrap it up with what's happening just in the top 100 market cap crypto coins. While the week's been pretty bad for crypto by and large, we did see a couple of nice ones. We saw Tron, which is the 17th coin by market cap, with about a 22% increase. Algo with about a 22% increase. Curve Dow token with about 17% increase, and then 1inch Network with about 14. So we had 4 coins this week that had 10+% increase in value for the week. And in a week that has been extremely volatile and mostly to the downside, but some pretty impressive returns for those coins. So I'm going to be taking a little closer look at those to see if there's any trade opportunities. And if we find anything interesting, we'll definitely let you know on the channel. But that's what's going on in the crypto space. Make sure you download the Toro Alerts app on the App Store. Remember, we've got crypto and stocks now, so you can download them both on the App Store, and you can utilize a promo code to get 1 free month. Thanks for tuning in, and we'll see you next time.